So the double tax trap, it's a trap for these two types of businesses. The first one is a business that has just started and has begun and it's made a profit. So a typical startup business has gone and maybe it's not the first year, but it's the second year they've made a profit. It's a double tax trap. The second type of business is the one that is growing at a fast rate, or they've gone into a profit situation where they were in a loss situation before. So what is that double tax trap? Well, it is a double tax trap because you have to pay two lots of tax in a very short space of time. Now, let's have a look at this. Okay, so you've made a profit this year, but last year you didn't make a profit. Okay, or the alternative is you made a small profit last year, but you made a bigger profit this year. Okay, so what happens there is that your tax installments are based on the profit you made last year, which in the situation we're talking about is very little or not at all. So zero tax. But now you've made a profit, and let's say your profit is $100,000 and you're a company and the tax rate is 25%, then all of a sudden you've got to pay $25,000 of tax on taxable income of $100,000 when you lodge your tax return. Now, if you're an Australian small business using a registered tax agent, you may not need to lodge your return until May the following year. So that's a good thing because you've deferred paying the tax. The problem is that you now have to come up with $25,000 of tax for the year that's just gone, or the year that went. Now, if you're lodging towards the end of the following year, we have a trap, and it's a big one, because what has happened is the ATO will schedule your pay-as-you-go installments for the following year or the current year of tax based on your most recent tax return lodged. Now, your most recent tax return had low tax because you had low income. So you have not been paying installments of tax based on your current income. You've been paying installments based on the previous low income or zero income. So you may not have been paying any installments. So now we come to, you've just lodged your return. Let's say you've just lodged your return for 2024 or 2023. You've lodged your return for 2023, and we now have the June 2024 activity statement on which you're paying your pay-as-you-go installments for the 2024 year. And the ATO will say, hey, you should have been paying installments based on the full year. Okay, we've estimated your taxable income for the full year is going to be another $100,000 because that's what you declared last tax return that you lodged. So your installments for the year should have been $25,000. And that June activity statement will be due, let's say, the 28th of July. But you still have $25,000 due in May of 2024, which relates to your 2023 year. So that's $25,000 there. You've also got $25,000 due based on your 2024 year pay-as-you-go installments. 2 years worth of tax within a very short space of time. We're talking 2 years worth of tax payments that you have to come up with in just 4 months. So that is a double tax trap. Then again, of course, your September activity statement for the following year, that's going to be based on your most recent tax return. So you're going to be up for another quarter of that tax. So another 3 months tax, another $7,500. So all of a sudden, you've gone from paying no tax regularly each quarter, and all of a sudden in about, let's say, that's 7 months, you're going to be paying 2.25 years worth of tax. That is a trap that we want to avoid, and that's where we've got to come in with careful cash flow and profit forecasting and understand what your tax obligations are going to be and make sure we plan for that in advance.